Hi, everybody. Hello. We're going to get started. We're slightly behind time, just letting the last people file in. Okay, guys, we're just going to get started. So can we have a bit of quiet in the room? Sorry, we'll have to catch up afterwards. Thank you so much for joining us today for Legal Voices for the Future's May knowledge session. I hope everyone at the back of the room and online can hear okay, but if there's any issues, then please do let us know so we can sort that out for you. I'm just going to do a few brief intro points on behalf of LVF before I pass over to our session leads to host today's session. Firstly, as always, we would like to say a huge thank you to LSE Grantham Research Institute, GRI, for hosting us. It's an absolute pleasure to be here. The GRI carries out world-leading multidisciplinary research into climate change and the environment. And something that might be of interest to our members is that on the evening of June the 26th, GRI will be launching its annual Global Trends in Climate Litigation Snapshot report as part of London Climate Action Week, which I'm sure will be of interest. The report takes stock of developments in climate litigation from the past year, and you can find more details about the report and the launch event and panel of speakers on GRI's website, or feel free to ask Emily from GRI, who is sitting at the back of the room today, who can tell you more about the event and GRI's work generally. Quick bit of housekeeping as well. If you hear a fire alarm, it's probably the real deal, so please exit the building. The fire escape is the stairs next to the lifts where you came up today, and the bathrooms are also located opposite those lifts if anyone is looking for those, so just turn left out of this room. So I will just move the slide on to our first slide here to give you a very quick run through of Legal Voices for the Future and what we do if it's your first time at one of our events, although I can see a lot of familiar faces as well as new ones here. I am Harriet, one of 12 stewardship committee members who run LVF. We are an organisation run by and for junior legal practitioners. We aim to bring junior lawyers together to learn and talk about legal issues that relate to climate change and the environment. The main way we do this is by hosting free monthly knowledge sessions like this one, and these cover a huge wide range of topics. Recordings of our past sessions are available on our website and YouTube channel. Which also reminds me, this session is being recorded, and if there may be some of our stewardship committee taking pictures in the room today, so if you would prefer not to be photographed, then just let us know. We will also be running a Slido for audience Q&A today. So you can ask a question via this platform or upvote an existing question asked by somebody else. If you've not used Slido, if you just Google Slido, go into the first link that comes up, you can then add the Slido code that's shown on the slide here to get into the platform. But also, if you prefer to just ask a question the old-fashioned way, then just put your hand up, and we have some mics in the room. So that's all from me. I'll now hand you over to our leads for this session, Varnika, Chawla and Tasha Lee. Varnika and Tasha are both LVF members and both work in legal at Climate Asset Management, and we'll be speaking today about the very live topic of nature-based investment. So over to you both. Thank you so much.
Thank you. Yeah. Amazing. So we'll start with some quick introductions, and we're going to be talking to you today about harnessing the power of institutional capital to scale investments in nature-based solutions, which is something that both Tash and I do on a day-to-day basis at Climate Asset Management. So Tash, do you want to begin with your intro?
Sure. Hi, everyone. Hopefully you can hear me okay, but let me know if I need to speak up. My name's Tash, and I am a legal associate at Climate Asset Management. My background is I am a Kiwi, so I started practicing law in New Zealand at one of New Zealand's top law firms, specifically in emissions trading law and climate policy. And then I moved to Australia and did a master's in environmental law and sustainable development at the University of New South Wales before starting with Pollination Capital Partners, where I did some more investment advisory work specifically around carbon and biodiversity markets and climate strategy with corporates and governments before starting with CAM about a year ago.
And hi, everyone. I am Varnika. I'm a legal director with CAM. I lead the legal function. And I joined nearly 2 years ago. And before that, I was an associate in the ESG and impact practice at Kirkland Nellis. And before that, I was a tax associate at Kirkland. So that's how I started out my career. But I trained in India before moving to the UK in around 2018. So my background is in emerging markets as well as translating private equity requirements from the global north into the global south. And maybe just really quickly about Climate Asset Management. So we are a joint venture set up between HSBC and Pollination with the aim to invest exclusively in natural capital. So we've got fund structures similar to a private equity format where we raise funds from investors around the world and then invest them across 2 different investment strategies. So our investment strategies are focused, one, on real assets, where we buy land and we make land-based investments for regenerative agriculture and forestry. So we repurpose existing land, which could have been used for more harmful purposes, into forestry or regen ag investments to then create both impact-based returns and financial returns for our investors. And our second strategy, which is more exciting to both of us, is the carbon strategy, where we've raised funds from investors to provide carbon-based financing to project developers in emerging markets, in Asia, Africa, and Latin America, where we provide catalytic financing right from a feasibility study stage to scale up a carbon-based project. So it could be forestry, blue carbon, agriculture, anything of that sort, to then generate voluntary carbon credits, which we then distribute on to investors towards their voluntary net zero or decarbonization strategies. So our work sort of straddles the 2 strategies, and we've just closed our fundraising last summer. So we've raised slightly over $1 billion to deploy across these 2 strategies in the next few years. So I think our aim today is for this session to be interactive. So please do ask questions as we go into the details of what is natural capital, why we should be investing in it, and what are the legal structures for investing in nature-based solutions and making this an institutionalized asset class. And then we've got a lovely all-women panel. I don't know if it's the first LVF panel to be all women. So we've got a diverse mix from research and academia, an investment professional from CAM, and then also a corporate associate from Linklaters who's dealing with a lot of structuring and regulatory concerns in the market. So please feel free to ask questions as we proceed, but we'll dive right in.
Great. So I think we'll start with a short presentation to give you a bit of background into nature-based investments, and then we'll move into our panel session after that. But before we get into investing and the role of law in investing in nature-based solutions, we'll whip through a little bit of a background about the problem that we're facing and how natural capital as an asset class is developing to sort of help form part of the solution. And so this first slide we've got here, unfortunately, paints a grim picture, which I'm sure most of you are at least vaguely aware of, is that we are at the moment undergoing one of the worst, almost unprecedented declines in biodiversity and nature loss that we've experienced in our time. its species decline and is at an all-time high, as well as extinction rates globally. And so I don't know about you, but I think when I was looking at, talking about the problem, for me, it sometimes helps to relate back to a personal circumstance. Like I grew up in New Zealand, and I grew up near the ocean and fishing and diving with my family. And I can see over the course of my life how it's harder and harder to fish or to, I think, go diving and see as much diverse aquatic life as I used to. And I think probably everyone's got their own story in this room about how they've observed that decline in nature over time. And so I think for everyone, there's sort of a personal story behind this, but more broadly, statistics that we're facing are 33% of the world's topsoil has been degraded, 32% of the world's forest area has been destroyed, 85% of the world's wetlands have been degraded, and 55% of the world's oceans that have been industrially fished. So as I say, a really grim picture and a very big problem. And so I think beyond the personal call to attention, what we're trying to sort of get into with the idea of natural capital is really starting to understand the connection between that nature loss and how important that is to our economy. So in terms of natural capital and how we start to approach that as a subject, I think it's really important to understand upfront that the global economy is fundamentally really dependent on nature, and the world's natural resources provide a range of environmental assets and services that underpin all areas of economic production. And so when we talk about natural capital and what that means, we talk about natural assets and also ecosystem services. And so I'll briefly explain that for anyone in the room that's not familiar with those terms. But ecosystem services are effectively the way we think about the flows of benefits from nature that are provided to our economy. And they're roughly bucketed into three main categories. Probably the most familiar one, or the most easy to kind of get your head around, is provisioning services. So these are the things that we take from the environment and consume or form part of the commodities that we would typically use in our day-to-day lives. So fresh water supply, food and fiber, fuel, and medicines. Then you have regulating services, which are a little bit harder to get your head around, but still, I think, probably familiar to a lot of you. Pollination, erosion and flood control, climate regulation, air and soil purification. So all the things that nature does to help maintain these particular ecosystems and I suppose, keep the economic functioning intact and operating it with integrity. And then the last bucket is cultural services. And these are the ones that you might think of as tourism recreation. So when you get outdoors and you're going for a walk in the environment, or tourism industries and how they rely on the integrity of our natural assets, and then also traditional cultural practices, many people know are incredibly important for Indigenous communities who have a strong connection to the environment. And so I think the tagline on this, as sort of looking at natural capital as an asset class, is really that we've got a system where nature has been overexploited but undervalued. And so what that means is our financial system hasn't really priced in what it means to continue degrading nature in a way that our economy is fully paid attention to yet. And so natural capital as an asset class is working to try and change that.
And essentially to change the narrative of how we use nature and how we assess not only our reliance on it, but also our impact on it. And economies and societies depend on natural capital, which is often a completely ignored term. So we at CAM and I think more globally through regulatory developments, but also voluntary developments, are trying to create this framework to reassess our view of nature and attribute a value to it, to make sure that investments in it are not only to mitigate business risk, but also to optimize opportunities to businesses.
And so that takes us to nature-based investments. And as Varnika mentioned, it's about attributing a financial value to nature. And so when we think about natural capital, it actually sits across multiple existing asset classes. And so despite it being a nascent concept, it's actually relatively familiar across lots of different classes of assets that investors would be already looking to invest in. So we'll briefly run through those five natural capital, or where natural capital touches across those asset classes. So nature market instruments and real assets, which is CAM's focus primarily in the investment world. Nature market instruments are what you'd expect, the carbon credits or water markets or anything where there's been a market created around a particular environmental asset or ecosystem service. Real assets sit more across where you are looking at acquiring a piece of land and improving the natural landscape alongside perhaps commercial returns, where you might have a productive agroforestry or regenerative agriculture project. Sustainably sourced commodities, those commodities that might be produced or sourced from sustainable practices according to certain criteria. So think of sustainably sourced cocoa beans or coffee as examples. Equities is where you would be investing in companies that perhaps prioritize sustainable practices. And so there'll be lots, I think, that's a growing area where businesses are paying attention to sustainable practices that they are, holding themselves to certain criteria. And then bonds, you might be able to touch a little bit more on bonds, but bonds typically is where you're financing environmental projects and the returns are kind of based on certain environmental criteria. Do you want to go into anything further than that?
No, absolutely. Cool. Well, I think we had a discussion just before this session on how to classify or discuss bonds. And one of the things that came
Very
up
nerdy.
was a rhino bond or a tiger bond, which the World Bank is currently working on, which is where they assess the species abundance of a specific species in a set area and provide financing to a country on the basis that as that species abundance metric grows, the outstanding loan amount or amount under the bond will decrease. So it would be linked to integrating and improving your climate or biodiversity goals, or linking it to water and water access or sanitation. So you can link bonds to several of these environmental or social criteria, which go beyond financial outcomes, essentially. But yes, at CAM, we sort of focus on the first two, as Tash pointed out. And an example of one of our assets would be where we've bought a plot of land, a huge farmland in Australia, which was originally used for sugarcane plantation and had a huge runoff into the Great Barrier Reef, which was causing a lot of coral bleaching and destruction of local biodiversity and wildlife at that reef. And we have then repurposed that entire area of land into a macadamia nut farm, which creates cash yield from the crop of macadamia. And apparently macadamia is also native to Australia, which is something new we learned in assessing that transaction. So you do create financial impact through the cash generating crop, but then you also create wider social and climate-based impact, because you no longer have that runoff. You're not affecting the reef quality, and in fact, between two different farmlands or two different forest lands, you can also create corridors for existing biodiversity to pass through into national parks, for example. So that's the sort of work that we're doing really across the globe, and it varies. And I think equities and bonds are, I would say, more development finance oriented as of now. I don't think there is necessarily a private finance institutional lens to it as of now, but it is increasingly growing as nature-based technologies like MRV, so monitoring, reporting, and verification companies, do come into play in the picture. But eventually they're all interlinked to form what we define as natural capital, noting that there is no global definition of natural capital as of today.
Cool.
And
I think
yeah, sorry.
good.
I think that's a good segue into what's driving demand.
Yeah.
I think that's our next slide.
Yeah.
Right?
So the last point on the slide was basically where's the incentive at the moment, and it segues into where we're going to in the next slide. But effectively at this stage, the benefit for or incentive for companies and institutions is that they can make environmental claims about what they've financed. And so the finance that they provide ends up being able to create that ability to sort of catalyze positive environmental outcomes and measure them as well, and have the tools and the ability to actually measure them through technology. But at the same time, we are looking to also, I suppose, change that narrative a little bit so that it's not purely about environmental claims, but really getting businesses to understand the long-term commercial benefits in investing in nature as an asset class.
And so we then dive into the meaty aspects of legal and regulatory developments that are driving institutional demand. And often demand is led by the emergence of regulation and increased awareness of institutions, of their dependencies on nature and their impact on nature. So we've listed out here a few frameworks, or I think quite many frameworks actually, which are leading to that increased demand. And these vary all the way from voluntary collaborations like the Sustainable Markets Initiative or the Integrity Council for Voluntary Carbon Markets, or the task forces that are being set up for climate-related financial disclosures or nature-related disclosures. And now, as of this year, there's a new task force, the TISFD, on income and inequality and social related financial disclosures. So it's starting to look beyond nature into beyond climate into nature, and then your impact on the wider community as well to ensure permanence. But it goes all the way into regulatory requirements, which have actually existed for quite a while in some jurisdictions. So things like the EU emissions trading scheme has existed since the early 2000s, where companies have a cap, the highest emitting companies have a cap and trade system based on which they need to cap their emissions every year. And if they're exceeding it, they need to trade it internally. And each year that cap of your annual emissions at an industry level is decreasing. So as of 2040, that cap will be zero, which means that companies at that point will need to have taken measures to abate all of their emissions internally within the industries that fall in the EU ETS. But increasingly, there are also evolving regulatory requirements. So I'm sure a lot of you here would be familiar with the European updates with the Sustainable Finance Disclosure Regulation that came in 2021, the CSRD and CSDDD, so the Sustainability Reporting and Due Diligence Directives, which essentially are largely disclosure-led directives, which in a way force companies to undertake a double materiality analysis and analyze not only the impact of their investment strategy or their financial impact, but also their impact on the environment and on nature more broadly. So you do have to assess if your investment activities are causing any significant harm to the environment under these frameworks. And actually, these developments are not only restricted to Europe or the UK. I think we should also, just as a disclaimer, ignore the US for the next 4 years, because they will be going in the other direction. But there are also lots of developments in Africa, Asia, and Latin America, where a lot of countries in these continents are coming up with their specific climate change regulations. So Kenya enacted its climate change carbon market regulations in June last year. Uganda published its climate change mechanisms earlier this year. Ghana has been one of the first countries from Africa to enter into 6.2 transactions with Switzerland. And then all of this is based on the wider context of multilateralism, which flows all the way from UNFCCC and the Kyoto Protocol in 97, and then leading up to the Paris Agreement in 2015, and eventually where countries submitted their targets and timelines, and that process of a country doing its greenhouse gas inventory analysis and then submitting its nationally determined contributions, which is essentially where countries are committing to reduce their emissions in order to limit increase in temperatures to 1.5 or 2 degrees of pre-industrial levels. And then we've got the new GBF, which came up fairly recently. And all of this is also then, in a way, led by voluntary requirements that are coming up increasingly. So we've got standards like the VCMI, we've got Gold Standard and Vera and Climate and Community Biodiversity Standards, or SD Vista, which are all voluntary standards specific to a certain asset within natural capital, which is voluntary carbon. And they all seek to have a quasi-regulatory mechanism for voluntary carbon markets going forward. So a mix of all of these developments has led to a lot of confusion in the market, but also to attention to the existing climate crisis and then the need to scale market participation and create business opportunities. And that's where we're seeing increased institutional investor demand in this new and completely nascent asset class, is where businesses are realizing their impact on the environment and are being forced to take actions to mitigate that impact so that they can appeal to the wider community, but also so that they can have a longer term sustainable business model, which isn't only focused on the short term.
Hope you've remembered all that.
And so we've and please feel free to ask questions, because I'm sure a lot of you would be very familiar with this information. So we've tried to keep our slides fairly broad in sort of touching on these different requirements and then doing a deeper dive into one specific asset class, which is carbon markets. And you'll see our experts on the panel are focused on carbon markets as well, and our creative content for later today is on carbon markets. And that's because that's the sort of class right now which sees a lot of attention in media, and often a lot of negative attention, without necessarily appreciating that it is a growing asset class. It is completely novel, and it hasn't yet been institutionalized because of a lack of regulation and regulatory developments. But increasingly, with the Paris Agreement coming in, and we've got Cindy, who's an expert on all of the different clauses of the agreement as well, who can talk to it in more detail. But with the mechanisms coming into force under the Paris Agreement and countries committing to their targets, it is one of the first asset classes within natural capital to scale. And following that, we expect to see a trend of scale in biodiversity, and then ultimately also on a wider social impact focus. So we're now going to do a deeper dive on the key legal issues and considerations that we deal with in terms of ensuring integrity and making sure that the sort of investments that we are doing with the investor money that we have raised are rooted in integrity and high quality, and they do make the environmental impact that they claim, and it's not just a greenwashing exercise.
Cool. Now the fun stuff.
So we've listed out here, and Tash, jump in as well, but we've listed out here a bunch of the key risks on carbon transactions. And often carbon transactions and carbon projects are very much focused on emerging markets. And that's because that's where the natural capital resource exists in abundance and at scale. So you will see the Amazon, for example, or blue carbon and mangroves, or large-scale agroforestry projects or sustainable grazing projects would be possible in developing markets, and that's because there's a greater area of land, and they have managed the land better so far as opposed to the global north or Europe, Australia, New Zealand, North America, where a lot of the land has either been used for agriculture or for commercial, industrial, or residential purposes. So often a lot of the risks are focused on emerging market risk as well. But maybe do you want to talk a bit more about specific project risks that we deal with?
Yeah, sure. So I think, as Varnika said, these projects are all really interesting because they're so different, and you're working with different Indigenous communities in each context, as well as different carbon methodologies. And so every single transaction is highly specialized and very different, which also makes them very fascinating. But in each circumstance, there's lots of different project risks that we would typically encounter. I think project partner capacity and capability, and so, you know, who you're working with when you're engaging in these projects, you have a really long-term relationship with these project developers. So you want to make sure that you know who they are and that they can do a good job. And to the extent that they need some more help, that we are setting them up to make sure that they will succeed, so that we, you know, make sure that we structuring a transaction to make sure that they are supported to be able to do the job within the boundaries of the law and to sort of get high integrity carbon credits as a result. So that's something that we often encounter is when we do a due diligence on a particular partner in country, what kind of support do they need to be able to manage the relationship positively long-term and productively long-term. I would say we have also talked about under-delivery and under-performance of assets is one that we typically spend lots and lots of hours negotiating and talking about with counterparties. I can see Brenna in the corner nodding her head. And so when we talk about this, the risk of carbon projects, because they are reliant on nature-based solutions, it's a really high risk that when you do your first carbon model and you project how many carbon credits a project might generate, which gives you your price per credit that you expect from a project, that there is a really big risk that project, something might go wrong. There might be a massive flood or a storm. Like natural disasters are one of the most typical risks that you would face in under-delivery or underperformance, but there's a range of different risks that might impact the performance and delivery of that project. So how do you, as an investor, make sure that you are protected to the extent possible from a situation where something goes wrong and then you have significantly less credits and you've invested a certain amount of money? And so that's something that we spend lots and lots of time negotiating with counterparties.
And maybe to zoom out slightly on what is a carbon project, and I don't know if you're all familiar with it or if it's useful to set that context as well. But as an example of a project that we've invested in through our carbon fund, we are working with around 2 million smallholder farmers across 3 countries in Africa, so in Kenya, Uganda, and Malawi, where the farmers own the land and you have to interact with the farmers upfront on a free, prior, informed consent basis to bring them with you along the journey of how they can better manage their land. For example, if they can do a mix of agriculture and forestry, so they'll plant trees at specific distances, and in the middle they can have native agricultural crops, which also will yield cash at a faster pace because the trees need to grow in order for them to sequester carbon and for you to be able to claim that carbon credit. So that's a project at scale where you're working across over 2 million hectares directly with smallholder farmers in different communities in a country or in countries where land tenure is not recognized and not formalized, because often the land is owned through a customary process by an entire community and it doesn't belong to a specific farmer. So you're in these projects, you're trying to bring in institutional level scale and capital where you're providing $70 to $80 million of funding, which goes directly into benefit sharing, procurement of the seedlings, monitoring, reporting, verification, and then the processes for registering your project on the carbon standard, for quantifying how much carbon is actually being sequestered by the trees over time, what that will look like on a longer term average, and eventually what are the carbon credits that you can then distribute back onto your investors. So that's the high level background of what a carbon project looks like. And of course, it can look different in different countries based on different methodologies. You can have a sustainable grazing project where you're working with communities where over a period of 6 months to a year, Maasai communities that are traditionally nomadic move to do rotational grazing with their cattle from one plot of land to another plot of land to let the original plot of land recover soil, recover its health, and sequester more carbon, because soil is one of the best metrics for carbon sequestration. And that's how you're then creating carbon credits. But that is a process in which you need wider buy-in and longer term buy-in, and it can't be focused only on the carbon aspects, because that would never then be a permanent project. But it has to be catalytic to the community. It needs to provide them with new livelihoods, a permanent ecosystem around them, and the ability to generate further income, for example, from cash yielding crops. So often a lot of the issues there are also regulatory, where these indigenous people or local communities don't have land rights, and so your carbon is attached to the land. But if you're working with someone who's not able to demonstrate that they own the land, how can they demonstrate that they own the carbon? And therefore, how can they sell the carbon back on to you? So that's where regulatory developments and risks come into place, where domestic and international regulations are revolving. What is the legal nature of a carbon credit? Does it flow with the land? Is it a natural resource? Does it belong to the government? Often, I think in one of our projects, someone from our deal team was asked, so you're paying me to buy my air, and what does that really mean? And so you have to explain it at that level, in the context of lack of regulation, or evolving regulation, while ensuring that the community has bought in for a longer term into the project as well. So those are the sort of regulatory and project risks that we often deal with. And then there are also market and country level risks. So the US pulling out of the Paris Agreement, what does that mean? Like, how does that affect investors in the US that have invested in our fund or are buying carbon credits? Are they able to use that towards their net zero claims? Are they able to make net zero claims in the US, for example, anymore? Or do they just need to be focusing on financial returns? Equally, is there corruption in the country in which you're working, or any kind of bribery concerns? Because often a lot of the payments down at the grassroots level are in cash. So how do you ensure that your $50 million or a part of it is not going into bribery or corruption practices within country? And then, of course, reputational risk associated with all of this. So example, Microsoft is investing in carbon credits all around the world, but a lot of the diligence that they carry out is to mitigate that reputational risk to them of greenwashing, or the Guardian article that came out a couple of years ago, or the BBC documentary that we're going to discuss later on as well. But often a lot of these risks are at play, and you're trying to bring global north requirements and disclosure-based requirements into a global south context, which is really challenging in translating those requirements into quality and integrity criteria. So the key, and I would say the 4 key aspects that underlie each of these risks and how you mitigate them, is to ensure that your carbon credit is real, it exists, and that country will recognize it, and the country in which you're claiming it will recognize it as well. It's measurable, which means that you have actually measured it. You've used standardized protocols, which are internationally accepted, like the GHG protocol, to measure what your emission reduction actually is in quantum, and it's verifiable. So it's not just a claim that you're making, but it has been verified by a third party. It's been verified by the registry that you're listing it on as well. It's been verified by the host country, and it's additional, that it's making additional impact. You're not just protecting a forest which already exists and is not under threat and saying, oh, give me 100 carbon credits for having spent $100 on protecting this forest, to which nothing would have happened in any case. So your financing towards the credit needs to be additional financing, which is catalytic to the creation of that carbon asset. And it's permanent, so it has to be longer term. You can't have a carbon credit for 15 years and you know, have a tree grow for 15 years and then claim the carbon out of it and then cut it 15 years later and still have a net zero claim, for example. So I would say those are the key metrics underlying all of these risk mitigation procedures.
Varnika, what's the typical timeline of some of these projects that you're describing? Can you give us an indication?
Well, it depends on it depends on your project partner capacity and capability, but I would say at a minimum around 9 months, but it could go on for 12 to 18 months as well, depending on the level of diligence, the evolving regulations, the documents that they have for domestic law compliance, and the scale of the project as well for signing up local communities and farmers. And often the FPIC process has to be carried out across multiple stages at different points in time. So that itself could take around 6 to 9 months.
So let's get it up and running. And thereafter, what's the life
Oh,
cycle
of the
the
project
delivery?
itself.
Oh, so typically a crediting cycle is around 40 years on Vera and Gold Standard, but permanence requirements are 100-year plus.
Which is where I think it comes back to that project partner capacity and capability, and particularly local community buy-in and engagement. I think one of the things I really like about talking about permanence in this context is that local community engagement and buy-in is completely aligned with permanence. It's, you know, ensuring that you have a permanent, long-term, high-integrity carbon project means that you have to be improving the status quo of the communities that you're working with. And so it's you're both aligned and motivated to make sure that this project lasts as long as possible. And so ensuring that communities have better outcomes from the project than they did before you invested is one of the most important parts of that.
So I feel like we've still got a lot of information to cover, but we're short on time. So we're also happy to discuss a lot of this detail after the panel discussion and the creative content. But very quickly, we've discussed the key criteria and quality requirements for what good looks like in a carbon credit. But how do you translate that into legal requirements? And these are the 5 stages that we would typically walk through in any legal transaction where we're investing in a carbon asset. Tash, do you want to do a deeper dive into
Yeah,
them?
sure. So we typically start with a preliminary legal or regulatory analysis, which is typically very high level, but we're assessing any foreign investment restrictions that might prevent us from actually being able to invest in those projects and then take the carbon credits and, you know, return them to our investors who, you know, aren't in the country itself. And then they'd be looking at the in-country legislation, what carbon regulations may or may not exist, and whether we can transfer carbon rights from a landholder and how that might actually be done in practice. So that's sort of like the first screening, like, is it possible kind of stage. Provided that we pass through that stage, we get into a more substantive and detailed legal due diligence, and we typically always partner with an in-country law firm, and they would run the full spectrum of legal due diligence that you would expect in any kind of financing transaction. It's just that it's tailored to a carbon context. And so they would be doing a due diligence across all of the land tenure, the carbon rights transfer for human rights and due diligence, all the typical corporate due diligence that you'd see in any kind of legal context where you're investing, and then start to identify those low, medium, high red flags. And particularly those medium and high red flags would be looking to make sure we're addressing them through later stages, through the actual transaction structuring itself, or in the actual transaction documents, whether that's through representations and warranties, or ensuring there's conditions precedent in the contract that are helping to mitigate those risks as much as we possibly can. I think that kind of touches on the transaction structuring and preparing, negotiating those documents, but that is a fairly intensive process that we'd work through. We have developed a carbon development and purchase agreement, which is our in-house template that we use for our financing, and that gets tailored to each of the different transactions. And as I say, that becomes quite a difficult task at times because each transaction is very different. But that's where we typically would be fleshing out all of the risks that we'd identified in due diligence to make sure they're addressed, and then also reflecting all the commercial negotiations that the investment team has agreed in the initial term sheet. And then the last stage is often a little bit spicy sometimes. It's the preparing security documents for registering. And
it sounds like the most boring, but it's the most important stage of any transaction, is taking security in what you're investing in.
Yeah.
And it's the most challenging because most countries don't have a framework to secure carbon rights or carbon assets.
Yeah.
And so it's quite challenging to be able to register an intangible interest in property that will exist in the future.
Yeah.
For which you're providing $50 million of funding today. And that's a challenge we face.
I described it as
regular
but yeah.
basis.
But yeah, those are the 5 stages that we would typically go through. Yes.
A very quick one, because I feel like that last thing touches on something you mentioned earlier when you made an offhand joke about somebody saying, you know, you're paying me for my air. What does that mean?
Yeah.
I mean, I think I know the answer, but do you see conflict in how structuring all these carbon projects in terms of what we would consider mainstream ideas about property rights and commodity ownership, and where that conflicts with the, let's call them indigenous social systems of a lot of communities that you're working with. And do you see those conflicts being resolved, or is it the case that they have to sign up and just play by the rules of, you know, the investors and so on?
Yeah, it's a very good question. I think it's challenging for us to answer it in all honesty, because often your security interest will be registered in your contracts with your landowners rather than in the carbon right itself, because the carbon right doesn't exist. But ultimately, when it comes to enforcing your security, what is it that you can do in that country? If you've registered a landowner agreement where you're entitled to X tons of carbon credits, but let's say the same landowner has signed up with another project developer for the same area of land and is getting money from two investors, for example, or doesn't understand what they have signed up to, in which case your carbon from that asset is no longer something you can quantify within your claim. So there's often that risk, and we do in our carbon modeling, and Renata can talk more to that as well, but we do account for a 5 to 10% leakage based on that risk often. In terms of registering the carbon right, I think some countries have the ability to register it as an intangible property or a commodity. But often, based on where your registry account is located, you can register your interest in the carbon credit that will be generated. So you will not be able to exercise a right against the landowner in country, let's say in Malawi, for example. But you will be able to exercise your right to a carbon credit in case it is encumbered or liened by the project developer in the jurisdiction where the registry account is located. And often, like Vera is located in the US, or Gold Standard is in Switzerland. So they do have mechanisms where you can take security over the carbon account itself, and so the underlying carbon credits that flow into it. But up to the point that that carbon right is generated into a carbon credit following the registry process, you are exposed to that local jurisdiction risk.
Does that, just a quick follow-up, because I know you want to move on, but does that not risk then breaking the linkage between, as you're saying, the right over the carbon credit and where and how that credit was generated? Because even if it's all in the Vera database, Vera itself has different methodologies, and that leads to different accounting measures and stuff like that. So my understanding is that, you know, carbon credits aren't truly fungible in that way.
Yeah.
Is that still a correct interpretation, and is that therefore a risk?
Yes, that is the correct interpretation. I think voluntary carbon credits within Vera are fungible across different methodologies. But for example, if you've got a credit on Vera or Gold Standard, those would not be fungible within themselves. So yes, that is still a risk. And have we ever exercised security? No. So does this system actually work in terms of if there is a default or enforcement of security? No. And so often your transaction structuring will try to deal with that asset level security, where so we'll try to take security at a share level in a project SPV that you set up to provide your financing into, so that you can step in and have all of the accounts and material contracts and landowner agreements, etc. But you'll also try to take security at an asset level, which will be in the contract credits that will be created in the future. And in the case of an event of default with the developer, it's typically at the election of investors whether you want to exercise your step-in rights or if you directly take over the contract credits that are being created in their account. But it's a very challenging area to navigate, and there's no uniformity or clarity on it as of now.
Thank you.
And I think that's where Mel's work is very relevant in providing insurance for carbon credit delivery. But that's where insurance companies come into play as well, is where you can insure your delivery risk. And especially in cases of under delivery or change in law, political risk, or weather events, often if you've got insurance in carbon projects, they will be able to provide you either with your money back, or some companies are also increasingly providing replacement credits to the amount that you had contracted for.
Yeah. I think, and one last point I will touch on as well, I think zooming out as well, some of the times the best security, non-formal security you can take is doing a really, really thorough FPIC and due diligence process. And we have an ESG team that does an extensive amount of due diligence to make sure that the landholders and the Indigenous communities you work with really understand the agreements that they're signing up to, what they mean by carbon credit, what those carbon rights are, and understanding what they're actually transferring. So you don't end up in a situation, ideally, where they are transferring them to another developer at the same time, and you potentially end up in a situation where you've, are unable to properly exercise your security. So I think that is one of the most important processes, really making sure that the communities you're working with understand and agree to the terms, and that's part of that FPIC process that our ESG team does. Cool. Any more questions on that?
And so I think this is probably our last slide.
Yeah.
But yeah, we've sort of listed out future opportunities and challenges, and this all sounds like this is full of challenges and few opportunities from a legal perspective. But actually, it's a super exciting area to be in legally, because the law is still developing, and whatever is going on today and over the next 5 to 10 years is what is going to determine the future of this market, but also more broadly other linked asset classes like biodiversity credits or social impact related work as well. So there are differing levels of legal sophistication across jurisdictions that you often need to work through, and also differing economic priorities. And often a phrase that comes up, especially in carbon assets, is carbon-based colonization. And that is a big challenge, where if you're working with Indigenous people or local communities and you're essentially providing money from developed markets and telling them what to do with their land, and they're bound to do that for the next 40 years and they can't do anything else, that can be seen as a form of colonization related to nature and climate. But that's again where your FPIC process is relevant, and also where your carbon project needs to be more than just about the carbon. It needs to be about the community, about the benefits it brings to them, the local biodiversity, and creating an ecosystem service around that project in order for it to survive longer term. And your local communities need to be a part of co-designing that project with you. Often they will be able to share a lot of Indigenous knowledge for which species of trees actually grow well in this area, for example, or which biodiversity will come through if you build a corridor here, and how that has an impact on climate as well. So it's very important to work with them as partners and not as entities that you're just providing funding to and instructing what to do. But that's a big challenge within this market. And then I think, as we've discussed, the legal framework is evolving. There's no global regulation. The Paris Agreement is coming up with 6.4 standards and methodologies for what good looks like. But as of now, there's no global definition legally of what that is. And you're essentially trying to bring institutional quality requirements into an asset class which is completely new, it's emerging, and it has different requirements to what your financial requirements may be for it to grow longer term. But yeah, those are some of the key issues that we face in this market. But we want to end on a positive note with the opportunities in the market.
Yeah, and so I think at a high level, these opportunities are what we're really trying to change and address the big problem of nature loss and really turn that around. So for us, these opportunities are pretty macro, but being able to demonstrate the financial value of nature to business and the economy, and legitimizing nature as an asset class, I think, particularly the legal side of it, is a massive, as Varnika mentioned, there's a massive opportunity to help shape and the regulation around a lot of these asset classes. You think of some of the highly regulated asset classes we have today across financial markets, and we're only at the very start of the journey with nature. And so there's a really big opportunity to do it right and to do it well, and to change businesses' perspectives on how we value nature as an asset. And I think part of what we've discussed today as well is working in a lot of emerging markets where, you know, Indigenous communities and people on the ground have an extensive amount of knowledge about how to manage the natural landscape for the better. And so being able to channel positive flows of capital into those communities, which are often typically most at need as well, is a really incredible opportunity day to day to be able to, I think, transfer that capital at scale. And also be able to do that in a way which works with communities, as Varnika mentioned. And then lastly, which seems a bit fluffy, but it's, you know, a nice way to end, is that in the really big picture, I think the reason why a lot of us do this is because we're really passionate about trying to solve the climate and nature crises. I don't know, it keeps me up in bed at night sometimes, thinking about, you know, what the world and what it might look like 100 years from now. And so if you can do just a small amount in your day-to-day lives or in my career, like, I think it's a real privilege to get to work in this area day to day and know that you are making some small amount of difference. And so I think that's a lot of the reason why a lot of, at least our peers at Climate Asset Management and a lot of the people that we work with more broadly do this day to day. And it's I know it sounds cheesy, but it's a privilege to be able to work in this space. So yeah. Anyway, that's,
Thank you.
yeah, the end of our presentation. I think
Are we doing any questions, or should we
move straight into the panel?
Yeah. Any questions? I think we have
Otherwise-
maybe a couple of minutes for questions. Yeah.
That was super interesting.
Thank you.
Questions, but what kind of ownership structures are you seeing governments of those? You mentioned that you bought a farm in Australia. Are you seeing like community partnerships or
So I think it depends on the nature of your investment as well, and where you're making land-based investments. Typically in developed markets, the ownership structure is more investor heavy, where the investor goes and buys the land. We have an operating partner to operate the farm in a certain way, which creates financial and nature-based impact. But for carbon projects, for example, we never buy the land, and we work directly with smallholder farmers or local communities. It could be on their ancestral domain land. And so the governance structure is often led by their internal community-based governance, where in the Philippines, for example, they have a system of elders that represent each community on each ancestral domain land, and they then participate in the FPIC processes throughout the generation of the carbon in the project, but the land remains with them, and the governance is based on customary practices in those sorts of projects. I think it differs based on different jurisdictions.
Yeah.
Yes.
I just want to know, are there any mics? The room is not that big, but I just had a quick question on, and apologies if you covered this in the beginning of the presentation, which I missed, whether you're seeing an impact on demand based on the new kind of regulations or some of the voluntary initiatives that are pushing towards decoupling green claims or targets, net zero targets, from the use of carbon credits. So I'm thinking about things like the SBTI, net zero standard, which says you should have 90-95% absolute decarbonization and only 5-10% offsetting. The UN high-level expert group report that also talked about only beyond value chain offsetting, or the CSRD has a similar concept of, if you disclose a net zero target, it should be 90-95% decarbonization. When you disclose your emissions inventory, it should be separate to the use of any credits. The Empowering Consumers Directive saying that if you've got a product claim about neutral or reduced environmental impact, it shouldn't rely on carbon credits. Similar concepts in the Green Claims Directive. So there seems to be a bit of a push, at least at the EU level and in some of these initiatives, moving away from the use of credits for these types of claims and targets, which I feel like historically has been what a reason or driver for in the voluntary markets for businesses investing in these credits. So are you seeing a shift in demand? And if not, or if there is still a significant level of demand, and what is the driver? I mean, I think it would be great if it was just for the sake of investing in nature, investing in carbon, solving the climate crisis, but I feel like investors might not always have those motivations as the primary driver for the decision.
Yeah, it's a very good question. I think you're right in that originally demand was largely led by being able to make these sorts of claims. But now with the Green Claims Directive and more disclosure regimes, companies are more watchful of what they say, and the scientific evidence behind their claims as well. So at least for investors at CAM who invest in our carbon fund, all of the credits need to be used towards their net zero or decarbonization strategies only after they have taken all internal measures possible to abate emissions within their operations. So you can't be using credits. And that's what I think the Oxford offsetting principles talk about as well. And SBTI is credits need to be a last resort where you have hard to abate emissions, which you're not able to abate internally. So I think there is a shift in that, but equally the application of that regulation is, as the Green Claims Directive hasn't come into force yet. The CSRD now only applies to very few companies that are the highest emitters, for example. So from a regulatory perspective, there isn't a huge driver towards what is leading you to make those claims, but increasingly you'll see litigation, including in the advertising authority, or I think just today there was a decision in Germany as well. But there was a Dutch High Court decision on Shell and their ability to claim offsetting and reliance on carbon credits towards their net zero target. So there's no regulatory requirement driving demand away from credits or forcing companies to invest in credits, but it's more if you are making a claim, it has to be backed by appropriate disclosure and scientific evidence, and it has to be clear and unambiguous. And whether you're using that for beyond value chain mitigation or in a regulatory net zero claim or a voluntary net zero claim also makes a difference. So if you're making a claim where you're contributing to the NDC of a host country, but you're using that towards your voluntary net zero claim, would be different than if you're using that credit towards CORSIA, but also in a host country NDC. So I think it depends. But increasingly, and I think also with the increase of AI, we're seeing a lot of tech companies looking to do beyond value chain mitigation, but also internal decarbonization, looking at these credits while they develop technologies that are in some form of the other lower emitting internally. Yes, Cindy.
Can I just add something to
Yes,
that?
please. Cindy is also one of the experts on the Oxford offsetting principles, so please do.
No, I just wanted to add a little bit on that on the CORSIA front, because whereas a lot of these schemes are voluntary, CORSIA is still in its first voluntary phases, but it will become kind of a compliance-based mechanism quite soon. And once that compliance phase kicks in, then all of the participating parties under ICAO, of which the UK is one, are supposed to create secondary legislation. And so all airlines under these types of jurisdictions will have to comply with CORSIA. And for those of you, I'm sorry, I'm speaking in acronyms, but CORSIA means the Carbon Offsetting and Reduction Scheme for International Aviation, and is the first kind of sector-specific international carbon market. And so airlines which emit above like a certain emission threshold will need to purchase carbon credits in order to comply with CORSIA. So once that compliance phase kicks in, we are suspecting that we will have a lot of demand for carbon credits. So yeah, that is one of the schemes that might drive it in the future.
Cool.
Last question while we get the panelists on the panel.
Shall we go? Okay.
Yes. Yeah.
No, I was just wondering about something you said earlier, that you have to prove that there is an additional value that you're making in terms of the carbon capturing or sequestering of a certain amount of land. So I was just wondering, how does that work when you're going to the global south and there is lots of land that is perhaps already sequestering a lot of carbon, but is not being compensated for it, and whether perhaps this rule might exclude, well, low-hanging fruits of people that are actually looking after the land and that are not being recognized for it. And obviously improved the practices and being verified internationally and so on, but that perhaps have not destroyed the land so that they can now restore it to be paid for it.
Yeah, and that's the part that most countries are in right now under the Paris Agreement, which is quantifying their internal natural capital resources and at a country level their emissions to then contribute to their NDCs. So I think that if and when that does come up, it would be in a country's NDC requirements where they would have accounted for that carbon that is being sequestered by a certain activity like agriculture or forestry within their country in setting their emissions budget and then baselining it to pre-industrial levels. So eventually under Paris, and yes, Cindy, go on as well. But under Paris, there will be a mechanism to account for those activities.
Yeah. I just wanted to mention that there are some practices, for better or for worse, that, for example, if you have a national forest, right, that is not essentially an additional project because it's being already protected, but there are evolving practices, especially in Africa, and I've worked on a couple of these projects as well when we were trying to monitor them, that project developers kind of create mini projects within these national parks, right, and they add some specific benefits. For example, they add protection against loss of biodiversity or, grazing, et cetera, et cetera. So if they prove that some of the benefits are additional, even within already existing mitigation measures, then they can essentially prove that additionality. Whether this is like a good practice or a bad practice, that remains to be seen, but these schemes are already working.
Thank you.
Thank you. And I think with that, we'll move on to the panel discussion and have a break after that, if that's okay. But please feel free to move in and out if you guys want a break as well. But thank you, all three of you. And I feel like you're all already very well known here, but maybe we'll just do some quick introductions. So we've got Prerna, Renata, and Cindy with us today. And I'll start with Prerna. So Prerna is an associate in Linklaters in the corporate M&A practice, with a particular focus on transactions involving climate-related investments. And her experience includes supporting, where she has written supporting, but also leading on transactions and investments into carbon credit generating projects and considering legal frameworks and commercial agreements involved in these sorts of financing transactions. And Prerna, similar to Tash, is also from New Zealand. And she joined Linklaters around 3 years ago, and before that has a combined LLB honors with a focus in environmental law and a BCom in finance, the right mix of climate and finance from the University of Auckland. And then, do you want to introduce Renata?
Sure. And so next we have Renata, who is an investment associate at Climate Asset Management, so working alongside Varnika and I, for the Carbon and Nature Fund, which is Apple's strategy. Renata has over 6 years of experience in private equity, asset management, and investment banking. And prior to joining CAM, she was an associate in an M&A advisory at Goldman Sachs in London, focusing on real estate in EMEA. Renata began her career in real estate acquisitions in Brazil. Renata is from Brazil, and then transitioned to asset management, where she managed a US $300 million portfolio of real estate funds in Brazil and the UK. She holds an MBA from the University of Oxford and a BSc in civil engineering from the University of Sao Paulo.
Thank you.
And then we have Cindy, and Cindy's an expert in the field, and she's a researcher with the Oxford Sustainable Finance Group, where she does research on the role of international carbon markets as a financing tool towards global net zero, with a specific focus on the Article 6 framework. But throughout her work, Cindy has explored how the law has the potential to shape these markets and to scale ambitious climate solutions. Cindy also consults international financial institutions and governments on integrated regulatory frameworks and approaches to carbon markets. And her expertise goes on, but it also expands to the role of litigation in promoting integrity in international climate finance levers and climate action more broadly. Cindy has also previously worked with the Grantham Research Institute on climate change and the environment, and as a consultant for the Oxford Climate Litigation Lab. She holds an MPhil in development studies from the University of Oxford, where she analyzed indigenous litigation against small-scale hydropower plants in southern Chile, and for which she also had a lovely few months in Chile, which I've heard about before. But we've got an excellent, super diverse, actually non-British panel of women today. So we're very excited about it because we sort of look to represent all different parts of the world. And the reason we've also given everyone's education backgrounds is to sort of give you a bit more of an introduction in how people got into this field and what led them to climate law or climate-based investments. So maybe we'll turn to each of you to briefly give us an overview of how you got into the field, what you love most about it, and then we'll do a deeper dive into the questions which we've shared with them beforehand. So Cindy, should we start with you?
Okay. I was prepared for this after the panel, but sure. I haven't been doing this for too long. I finished my MPhil at Oxford, which is a 2-year degree, about 3 years ago now. And during that time, I wrote my thesis on indigenous litigation against small-scale hydropower plants, as you just heard from Varnika. And the interesting thing about that and what tied it with carbon markets for me is that these hydropower plants were CDM projects. So they were under the clean development mechanism of the Kyoto Protocol, and they were recognized as valid carbon projects at the time. So I came to carbon markets from a very critical standpoint because I had seen how actual communities had been mistreated and their rights had been violated by these types of projects and how they were consequently litigating against them. So I started working with the Oxford Climate Litigation Lab just, I think, very shortly, a couple of weeks after I had graduated. And I worked on that from the legal perspective. And we very much looked at how litigation could actually help improve carbon markets. And from then on, I continued this work at Grantham. And now I'm back at Oxford, but at the Sustainable Finance Group, in which I look more broadly at the Paris Agreement framework and how international carbon markets, and particularly shifting from that focus on voluntary carbon markets to quasi-compliance and to more compliance-based markets as well. So the way that I got into it is very much, as you can see, just bobbing along between the two institutions, so LSE and Oxford, working with the same teams, with the same kind of people, but on different types of projects. And the way that I've gotten into a little bit more of this consulting of actually working directly with governments or working with international financial institutions as well is, again, when you develop this type of expertise, that when you start publishing and researching as well, a lot of these institutions come to you for advice, and you can do a lot of very interesting projects that are very tailored to specific stakeholders as well. And I'd be very keen to talk to every one of you in this room, specifically those who think that going into academia will be just quite boring and dreadful as well. I promise you it's not. You get to do a lot of interesting stuff sometimes. And I joke sometimes with my colleagues and I say, it feels like I work in the private sector, but I really don't. So yeah.
It's not that bad, Cindy.
Is it not?
But Renata, over to you, as you do work in the private sector for good.
Exactly. No, so my story basically, as Tash said, I worked in real estate, private equity in Brazil. I really enjoyed investment in real assets. I really enjoy investments, asset management. But real estate was something that I was in kind of wanted to transition in my career. Then I decided to do the MBA, and then I went to Oxford, and Oxford has a great climate community. There was a lot of focus in climate and engagement. So it was more like, okay, this area is very interesting. I think I can leverage some of my skills, investments in real assets. Then I actually found out about natural capital because I don't think there was a concept that we even discussed 4 years ago in Brazil. So I did not know what it was. Then I got to climate asset management. I actually did an internship with the natural capital team. So was very lucky also to be able to close a transaction in Iberia with almonds and olives. Was really nice. I had also a period of time that I went to investment banking. And then I realized actually that's not what I wanted to do and had this opportunity to transition back to climate asset management. And then the carbon fund was something that they needed someone at the time. And I thought, okay, that's something interesting. And I think that will actually combine with the experience I had in natural capital. And in the end, they are very interrelated, as they said. I think you can work across both strategies. And that's mainly how I got into it, and I really enjoy. I think you can, if you worked on investments before, if you like asset management, it's mainly trying to set your head around on how you look into these investments. But in the end, it's sort of land that generates income, it's acquisitions or leases. And then in the end, but carbon projects, I have to say, are much more complicated than any real estate investment. Yeah.
And Prerna.
Hi everyone, I'm Prerna. As Varnika says, I'm an associate in corporate M&A at Linklaters. My background is actually quite straightforward, but also varied. I also haven't been doing this very long, so I've been here for about 3 years. I studied in New Zealand. I did an LLB honours and a BCom in finance and management at the University of Auckland. And while I was at university, I actually did a variety of kind of random stints. So I did try my time in corporate law first. I did an internship at Chapman Tripp, another firm in New Zealand, not the same as Tasha's. I did an internship at Allens, which is a law firm in Australia. I then did an internship in strategy at EY, which was quite interesting actually, because I think it gave me a lot of the more commercial perspective and structuring of transactions. And then I did a slightly academic research-based internship at the New Zealand Centre of Environmental Law. And I did that at the same time that I was doing my dissertation for my LLB honours, which was actually in around the incorporation of tikanga, which is Maori law, into our environmental legal system, which is super fascinating. And one of the things I miss the most about New Zealand is our environmental law is like what I didn't appreciate is kind of world leading and quite special. So that was great. And then when I came here, I knew that I wanted to do something in environmental law. I started at Linklaters and I trained here and I'm loving it. But of course, it's a very corporate heavy firm. I'm very grateful and honestly quite happy to have found a sort of carbon niche in which we do a lot of commercial and environmental work, and it's super interesting, super dynamic. I work with some really intelligent people, which Varnika and Tasha will attest to. And I think also that one of the coolest things about it is the type of clients that come in the door in the carbon space, is you get investors that actually care about what they're doing, which can be a little bit different to other types of clients, which is awesome. And honestly, one of the coolest things as well is that people who are investing in carbon markets are choosing to invest in carbon markets. A lot of things make money, and carbon credits will not always be the primary incentive for those investors. They're choosing to invest in something that's good for the world. And of course, that can be a naive perspective, but it's also often true.
Thank you.
Great. Thanks, everyone. I think it's lovely to hear such a diverse background of, where you've all come from, and also the passion that you all have when you speak about, where you have come from and how you've landed where you have each landed. So that's really great. We're going to get in some questions. And so we have some prepared. And I think the first one we have is actually for Prerna. And so in the context of the work that you do at Linklaters, you've advised on transactions involving carbon credit generating projects, as we've discussed. And so I think it'd be great if you could talk a little bit about what legal complexities or risks are most critical for institutional investors to understand before entering into these markets.
Yeah, absolutely. The background you gave was really helpful, and you've touched on a lot of these already. The way we kind of look at it is there are sort of two overarching categories of risk that I think investors would need to be aware of. The first is kind of like the overall market risk. And we touched on this before, but essentially, like any other product, the carbon markets are driven by demand. If we don't have demand, we don't have a market. Demand is driven by usability. Usability is then threatened by the uncertainties in regulation in the market. And as that grows, whether there is a use case for carbon credits shifts and it fluctuates. And sometimes we can't predict what that will mean for the future. And we can obviously look to things like CORSIA becoming compliance-based and try and predict an increase in demand, but then equally there could be other factors like countries can pull out of CORSIA. So there are often factors like that we can't predict, and that means the use case of carbon fluctuates, which then means demand in the market fluctuates, and that's a key concern for institutional investors. So at a market level, that's something that we often see investors caring a lot about. And then at a more transaction level, critically, investors kind of want three things. They're primarily concerned about three things. And the way we'd see this is that first you have the outcome certainty. So that's your financial incentive, basically. You want to know that what you're getting is what you're signed up for. Then we have primarily reputational risk, which we can look at as separate from financial risk, and that might be project-based. So you might be investing in a project which later you might realize comes to have human rights abuses, or maybe is not generating credits with integrity. And those risks are sort of separate from financial, but obviously investors will see them as a financial liability as well in due course. The reason that is particularly important to carbon credits is because often those project developers will be like NGOs or startups and won't necessarily be very sophisticated. So that can actually be quite a key concern. And then the intersection between those two is when you have financial risk due to, for example, your credits not being your credits being verified by a body which goes through its own reputational crisis. So for example, if we look at the Guardian article, if you're investing in a project which then undergoes that, then you might lose your credits, and then you might also face reputational risk by being associated with credits that have been verified by a registry like that. So that is kind of the three buckets in which we see risks at the transaction level.
Thank you, Prerna. And I think that ties in well with the question for Renata, which is, Renata, what are the sort of key screening criteria at an investment level that you look at and apply when you're evaluating nature-based projects for scale and impact?
Yes, thank you. Yeah, a lot of the topics that we screen have been touched also by you and Tasha was very good. But I think some four key criteria that we looked at. The first one I would say is the technical criteria. So we will look into projects that already have a sort of a feasibility study developed, they have a pilot in place, and then we can actually go on site and visit these projects, because a lot of the projects that come to us, they're just an idea, and there has been no engagement, no land identified, or no process being in place, and that makes it really complicated for us to evaluate any investment. Also on the technical side, we always receive a financial model that we will look into what are the project costs that they expect to have, because that will size also the investment ticket for us. And we also have to make sure, as with the point that Tasha and Varnika touch a little bit in the beginning, is permanence and additional permanence mainly, because we have to ensure that these projects have enough budget to sustain along the 40 years of the crediting period that they have. Because we sometimes encounter some projects that require 80% of the amount of the investment to be deployed in the first years. Then there raises some questions of, is this project really going to be there in 10 years time or 15 years time? And then building into the second point, which is the developer capacity. We will, of course, in an ideal world, we will want developers that have a strong track record. They partner with NGOs or like well-capable implementation partners on the ground, but that's not always the reality. And we always try to work with these developers to understand what is their capabilities today and how can we actually improve them over time and get comfort also on the things that they don't exist yet. So that's something that we will also evaluate, and that also can grow over time, because you get to know, there's, as Varnika said, these projects, sometimes the evaluation period is 9 months. So imagine interacting with them for 9 months, you really get to know of what they're doing and what are the responses and how can you actually cooperate over the long term. Third point would be ESG and impact. Of course, we will look into what is the land eligibility. Most of them touch upon the fact that we have to look into areas that are degraded, and that the projects will transform the land. So we can do we have third-party vendors that work with us and help on ESG, how you can use GIS to identify these areas. We will look into the communities and make sure, one interesting thing is always making sure the communities benefit compared to their baseline. So, I mean, sometimes when you look into these developing markets, if they receive an additional income of $2,000 per year, it might seem that it's not that much, but compared to their baseline, it is actually quite relevant. So we always have to make sure that we quantify also these benefits to communities. If it's also from products that, let's say, cashew or bamboo that they harvest, or even from the benefit of the percentage of carbon credits that they might get in the project. And finally, I think is the investment alignment. That's very, very specific for CAM, that we invest in exchange for credits, but there are other investors that might also invest for financial return, so they can opt also to sell credits. So there always be a mandate alignment that you have to follow. For example, how much exposure can you have to a certain country, a certain market, a certain type of project? So we always have to make sure that we comply to all these 4 criteria.
Great. Thanks, Renata. I'm conscious we are actually sadly short on time because you all have so much to say, which is excellent. But we will jump to Cindy now, and we had a big question for you, but I think we're going to cut it a little bit down to focus particularly on how legal frameworks are adapting to help standardize and de-risk nature-based investment structures, and particularly across jurisdictions.
Okay.
But also feel
will-
free to touch on the lack of regulation.
Yes, no, I can try to keep it short. I do have a lot to say, but we will also have a networking kind of pop event after this, so feel free to ask me any questions then. So I think I would want to take a bit more of a zoomed out approach when it comes to regulations for nature-based solutions, because when we talk about nature-based projects, they're not all carbon projects, right? And the way that you regulate nature-based solutions is not only through carbon market regulations. And so I think the way that they're becoming more standardized now is that this is being very much accepted. So you can have a nature-based solution which can have mitigation properties or adaptation properties, right? It can fall under adaptation national targets or mitigation national adaptation targets. It can fall under carbon market regulations or otherwise. So I think when governments are trying to regulate this space, the question that they come to us often is like, how do we make sure that we are adding like additional financing or regulating additionally for like mitigation projects or nature-based solutions? And I will give like a very hypothetical example for this, but also rooted in some conversations I've had with policymakers. So for example, let's say the UK is falling short on its financing gap for woodland creation, right? And it needs to fill in that gap by attracting private finance. And the way that they want to attract the private finance is through voluntary carbon markets, so opening up the UK economy to the international VCM. And so they are seeking to create specific regulations or guidance in order to de-risk those investments and to ensure confidence in market participants, right? However, woodland creation schemes are already regulated under the Woodland Peatland Code. They are already regulated under AFOLU schemes, which are kind of land use management regulations as well. So a specific type of nature-based solution, which is woodland creation, then becomes privy to very different types of regulations. So how does the government deal with that? And this is risky for investors who typically need to prove that financial additionality in the mitigation projects that they are investing in order to, particularly they use them for offsetting purposes. So I guess when we talk about standardizing regulations, we talk about providing cohesiveness in the ecosystem as a whole. And how do we see carbon market regulations fitting and being embedded into wider national regulatory frameworks? And also, when we speak of standardization, we also speak of the actual standards that exist in this market, right? So a lot of regulations, what they try to do is to ensure that they have proper criteria for carbon unit quality and also for the claims made. And what they will typically do, if you read specific regulations, is they will endorse specific standards. In its consultation right now, for example, on nature and voluntary carbon markets, the UK is assessing whether they should endorse the ICVCM CPP principles in order to ensure that supply side criteria, which we at Oxford are very strongly against. But I can go through that another time. Or countries can go through another route and they can say, you know what, everything that is existing right now and everything that these private standards are coming up with are not robust enough. And so we are going to create our own national standards and methodologies that are very much tailored and adapted to our national realities. And this is kind of something that Portugal is now doing, for example, is created its own domestic voluntary carbon market, and it's very much creating its own public methodologies and standards. And also, they're also aligning with the EU CRCF, which is like a wider topic that I won't touch into it right now. But I wanted to touch also on claims. So once they have regulated the supply side of the market, how do they regulate the demand, the demand side, but also like very critically the claims that investors can make on the back of these projects. So there is this shared understanding that investors in nature markets should not engage in greenwashing practices. We often get asked by a lot of people in the private sector, a lot of investors, about what claims are they allowed to actually make under a specific jurisdiction. Can an investor in nature-based solutions use the environmental benefits from nature-based projects that they have invested in to claim offsetting? What does offsetting mean? Should they claim offsetting, or should they claim contribution, or should they claim compensation? And for what purposes? And if they claim they're towards their own companies, like organizational net zero targets, can these then also be counted towards like national GHG inventories? Should they correspondingly adjust for these? So I think what regulations are now missing is not just, what types of standards they need to abide by, but also this like very clear guidance on what claims can investors make and what constitutes greenwashing practices and what doesn't. And I will also come back to that later if we speak about integrity as well.
Thank you, Cindy. And I know you have a lot more information to share on all of these aspects as well. But in that convoluted and evolving regulatory context, Prerna, what role do commercial agreements and bilateral private finance agreements like emissions reduction or carbon development and purchase agreements or revenue sharing mechanisms play in building investor trust and confidence in carbon markets?
Yeah, so I love ERPAs. They're so much fun. An ERPA is an emissions reduction purchase agreement or carbon development purchase agreement. So they're quite similar. Basically, an ERPA is sort of key to these carbon transactions because it lays out the agreement between the investor and the project developer, or sometimes just the person who's selling the credits. And a good ERPA will very clearly spell out what the obligations are between the investor and the project developer. Now, one of the, again, cool things about these type of transactions is that often the interests between the investor and the project developer are aligned in that you both want the success of the project. You want the project to be successful because in that only if it's successful will it generate the credits that you've kind of agreed to buy. And then also you want permanence, and then you also want community engagement and benefit sharing, which I'll come to shortly. So a good ERPA will sometimes you have an investor who's kind of like a big dog and a project developer who's like, just a little guy, local developer, but actually the investor kind of needs to help the developer in agreeing to obligations that they can actually feasibly do and carry out. And so in that way, the obligations in a good ERPA will spell out exactly what the developer needs to do by when, and it will make sure that they actually can do those and have the financial ability to do those. Otherwise, the agreement just won't work, and the investor's interests are also not met. Also, an ERPA should very clearly spell out when the credits are generated and when they're delivered to the investor, when title passes, how much money the investor is going to pay. All of these things help deliver a lot of certainty to the investor in a scenario where certainty is quite rare. And so you can understand why investors are particularly keen to make sure that their ERPAs are very robust. And that's where we would come in as lawyers or external counsel. In that, in terms of benefit sharing, we'll just quickly touch on that. That is actually it's often quite difficult to ensure good benefit sharing through commercial agreements. And the reason why that can be the case is because the local communities might not necessarily be very sophisticated. You might not even have a contractual nexus with them. You as the investor might agree, okay, the developer needs to create these opportunities for the local communities, but what do the local communities do to enforce that if the developer fails to do? What can you do to enforce that? From an English law perspective, you can bring a claim, but then you need to show loss, and you haven't suffered loss yourself. And so that can be quite a key contractual issue, and that needs to be worked through in a lot of detail, particularly when it's quite important to investors.
Thank you. And then linked to that, Renata, what do you think are the main challenges and levers when deploying institutional capital into nature-based projects and making sure that Indigenous people and local communities are included in the financial structures that we build within those projects?
Exactly. And exactly as it has been touched upon, right? Like sometimes the investor is a big fish and then the developer is dealing with someone very small. So of course, one of the challenges is finding also these large scale transactions. We usually have a 20, 30 million ticket size, and that needs to be absorbed in like 1-2 years by the developer to deliver the credits in the time frame that we need. So, I mean, finding these large deals is a very complex, it's very complex. And then, so how we're trying to come up with different structures that we're able to deploy our institutional capital, not only through an IRPA, but also through other agreements. So we can also do, for example, a debt style investment where you fund and then you get the credits back, but you can also do an equity investment when you invest more for project risk and over delivery. And that might be more aligned with the developer, depending on the stage. If the developer doesn't have a balance sheet to secure investment, then they can also be onboarded on an equity structure. And then interesting is that some of these projects we also try to structure them in a way that we look for projects that not only are relying on carbon sometimes. So we look into projects that have other sources of revenue streams, and that allows us also to provide capital and be exposed to the project in different fronts. So we are doing, for example, a prepayment for carbon, but we also benefit from, for example, offtake of bamboo, or we also benefit from sale of açaí in Brazil, or coffee or cocoa. So these sort of projects, we also try. The investment ticket is bigger. That allows us to go to other markets and maybe have other source of security when the developer is not able to provide a financial guarantee or insurance. And I think on the community point that you asked, we're trying to come up also with other solutions for benefit sharing and Indigenous communities, such as instead of promising a share of carbon, we're trying to put those benefits already in the project cost. For example, developing a community fund where you invest directly in infrastructure, but that is always, we try to do these investments based on what the communities want, what is more beneficial to them. So I was, just a practical example, I was in a site visit for a project in India, and then the community was very excited about having the trees. And they understood also, they were aware of the credits and everything they were getting. But the first question was always, but are you building schools here? So that was something it was really, I mean, how can we also make sure that our projects have the impact beyond nature, but also the social impact? So we try to build this into our investment quantum.
Thanks, Renata. And I think moving out into a sort of broader, sort of more international view, Cindy, we've got a couple of questions for you around the role of the Paris Agreement in driving investments, and also how some of these international frameworks are ensuring high integrity more broadly. So I think if you want to choose a particular focus or cover both, generally we're keen to understand from you, we often get asked about the relevance of the Paris Agreement in the context of driving investments and operationalizing natural capital in the form of carbon markets. But as we know, the agreement is still underutilized at best at this point. So what do you see the key strengths of the Paris Agreement, and how can these be utilized to operationalize markets at a national level? And then more broadly, how are you seeing these international frameworks actually ensure high integrity project pipelines?
Yeah, I'm happy to answer those, and I will really try to keep it brief. So I will actually say this, we were actually at a workshop with Varnika a couple of weeks ago, and we got asked by one of the participants, so why the Paris Agreement? Like, why do you think that is so important?
By a professor.
Yeah, you're a professor who works on this topic as well. And I was thinking about it and thinking, this is the only kind of effective, like, multilateral treaty that we have in order to address climate change, and it is very much underutilized, and we need to utilize it ambitiously. And even if you read it, it is like some of the provisions within it are very, very ambitious. But the thing with the Paris Agreement is that it is under like public international law, and for elements of it to be operationalized correctly, it needs to be translated into national legislation, right? And tailored to national realities as well. So states are very much co-creators of the norms and responsibilities enshrined in the Paris Agreement. When we think about nature-based investments as well, I know we concentrate a lot on, again, market-based mechanisms, and particularly Article 6, and I will delve into that a little bit. But I think it's important to, when you think about nature-based investments, to think of all the levers of the Paris Agreement that can actually attract finance towards these types of projects, right? You don't only have Article 6, which is it creates like market-based mechanisms and also like other cooperative frameworks. But you also have Article 5, and Article 5 stipulates responsibilities for countries to engage in results-based finance. You also have Article 9, which is like about adaptation projects, right? And very much about those international climate finance obligations of states. And as we said before, a lot of types of nature-based solutions can also be adaptation projects as well, or have adaptation properties. And if you actually go back and you do this, it was such an interesting exercise if you're nerds like me about these types of things. If you read the original Kyoto Protocol, it is so ambitious that it even says that avoidance projects, these big red projects that were kind of taken down by the Guardian article, and they're used like very commonly now to generate carbon credits, they were initially not mitigation projects. They were considered like adaptation projects under this typology, right? So we have all these different levels of the Paris Agreement, and what is important is how are they utilized correctly and efficiently at a global scale in order to reach the mitigation goals, especially and to scale up nature-based investments. And I will touch just very, very briefly on Article 6. So how Article 6 departs from its predecessors, which are like the CDM under the Kyoto Protocol, or even the voluntary carbon mechanism, is that carbon market, is that it really tries to forefront those issues and environmental integrity and sustainable development. It is right on this very definition under the Paris Agreement. And it does so through 3 different mechanisms that I won't go into right now. But it isn't showing. It shows a lot of promise, but the first kind of transactions that are happening under Article 6.2 and 6.4 show that there is kind of a lack of environmental integrity at the moment. This is still a very nascent market. It is still very immature, and it still has a lot to learn from the legacy of the different markets it builds upon. But again, we are seeing the same issues with environmental integrity. And this is where I really want to touch on like what in my mind is the biggest issue with integrity, and what also brings up this like greenwashing practices that we see so often when investors utilize carbon markets, and is that issue of permanence. If you look like from a scientific perspective, if you are utilizing carbon markets to do offsetting, what offsetting actually means is like it establishes a physical equivalence between the emissions that you are releasing into the atmosphere with this carbon removal units that supposedly purportedly counterbalance those emissions. But those emissions that you're already releasing into the atmosphere, the life cycle of them is so long and so permanent, and you need kind of removals. So actual like sequestration of carbon for that same life cycle, for that same durability, like which is to be geologically meaningful, it needs to be 1,000+ years in order to offset those emissions. So what happens when a company is saying that I'm offsetting my fossil-based emissions with a project like which is sequestering carbon only for 40 years? That is not an offsetting practice, right? And so this is where a lot of these claims are very much contested. And you can do things that you can do a lot of innovative things with that, right? You can renew the contracts, right? And you can keep purchasing from these like shorter term nature-based investments. But in order to claim offsetting, you need to have that geologically meaningful like removal at the end of it. And that is, for better or for worse, there are so many environmental consequences of these types of projects, but you can only do that with technological removals. You can only do that with direct air capture. You can do that with BECCS, with enhanced weathering, or with biochar, right? That doesn't mean that carbon markets shouldn't be a way in which we utilize like nature-based solutions, and they still will be an important tool for these types of projects and to ramp up investments, particularly considering the composition of these markets right now is mostly on nature-based solutions. But I think ultimately we will be moving towards that use of carbon markets for specifically removals with longer durabilities. And then we have to look at other levels of the Paris Agreement in financing the shorter durability nature-based solutions as well. And I'll leave it at that.
That controversial point.
Controversial, but yeah.
Thank you. With that, I'm also conscious of time. And do we have time for a couple of questions, Harriet? Or
I thought we could maybe start with a couple from Slido. So we've had quite a few come in.
Okay.
I can just ask one or two, and then we might have to limit to just one more question in the room, if that's okay. Second. And the mic onto everyone online can hear me. So our top question online on the Slido is what are the disadvantages or advantages of separating ESG issues into specific financial instruments instead of ensuring ESG issues are considered across all financing? Don't know who would like to take that one.
That's a hard question. Brina, do you want to take that?
It's very complex. I would say that I think it brings more people into the game. And often we see a lot of, like I said before, we see a lot of clients who care, which is great. We also see a lot of clients who are investing in the market to kind of keep up with their internal mandates or policies and stuff like that. And that might not always be, you know, the greatest thing, but actually they're investing. And I think if we combine all of the, you know, if we combine ESG considerations with the carbon mandates that some companies have, we might lose a lot of the bigger players that we have in the game right now, like big banks and stuff like that. So from my perspective, that's what I would say. I think it brings more people into the market and it makes it slightly easier to enter. But yeah, I hope I've understood that question correctly. But if anyone wants to jump in, feel free.
Yeah, maybe I can jump in, having worked in a specific ESG and impact practice before I moved to CAM. One of the internal challenges we faced with our own existence as a team within Kirkland was, what is our relevance and what sort of lawyers are we? Are we corporate lawyers? Are we funds lawyers? Are we debt finance lawyers? Are we just ESG lawyers? Because ESG needs to be integrated across all of these different practice areas within a law firm, but in any kind of investment strategy as well. And with the emergence of EU regulation, we're increasingly seeing that interdisciplinary, cross-cutting nature of ESG across departments. I think longer term, will ESG survive in and of itself independently as either a legal practice area or investment considerations? I would say no, because we're seeing under regulation, you are having to impose those criteria across all of your investment strategies and disclose whether you're taking into account sustainability risks, whether you're pursuing a sustainable investment objective, whether you're promoting an environmental or social characteristic, and that goes beyond just ESG into the details of your economic or investment activity as well. So I think longer term, it is important to bring everyone along that journey, but that needs to be a global journey, and there's no consensus on that right now, especially with the anti-ESG movement in the US, which is increasing as well. So I think for now, short term, it is important that countries and specific jurisdictions do implement laws that are applicable within that jurisdiction, but broadly to have a greater impact, it will be important for it to be a global consensus-led practice area, which isn't exclusive to certain jurisdictions or asset classes as well.
Thank you. Brilliant. And I'll ask one more from Slido. Just briefly, and I think this actually leads quite nicely into the creative content session. Somebody has asked, how do you reassure investors that carbon credits have integrity, particularly given the poor media coverage that the voluntary carbon market often receives?
Oh, I can think about it. But I feel like you're gonna say no.
But no, it's not that. I think I think ensuring integrity, you have a lot of very robust like carbon credit ratings agencies as well. Like we need to understand that the carbon market was a very undeveloped market, right? It did not have all of the ancillary services that financial markets usually have. Like, and there are very recently being developed things like insurance, like carbon credit rating agencies, and as they're being developed, they're being like becoming more and more sophisticated. So there are definitely ways in which you can ensure the integrity of a project. I think where the problem is sometimes with carbon projects is that we talk about environmental integrity, and what environmental integrity means in this concept is not about, you know, ecosystems, biodiversity. It's about the environmental benefits from that project. So the unit ensuring that the carbon unit derived from a project is actually of a high quality. So if it satisfies permanence, additionality, leakage, and I'm forgetting robust baselines as well. But there are other, if you look at integrity, I think you need to consider like ecosystemic integrity as well. So you need to consider social integrity, which is very hard to measure, to report, to verify as well, and that broader like environmental question as well. So there are ways to do it. There are services out there, and yeah, hopefully the markets are moving in the right direction.
Can I just compliment on that? I think that's something that is a point also that's very interesting, is that we as an investor also, we have to remember also that in the end, some of the LPs and everything, they're looking for credits that have high quality, but also credits that they can invest and produce at a lower cost than what they can buy in the market, right? So that also sometimes is very challenging for us, for example, asset managers, how we also ensure this integrity and quality, because if we could, we would only invest in capital and the projects that have the highest quality standards and the highest integrity, but that's also not actually reflected on the cost that the credits that you generate and then the returns that you will make. So there's always this there needs to be, I feel, more alignment on what are we actually solving for, because there's so many parts involved that one is looking for returns or is looking for high quality, and then how we can actually combine. Because sometimes we look for, let's say, if you want to have something very super high quality, but if you're not deploying as much, investing that much, then like unlikely that you get that.
And that's where your point, Prerna, comes in on having a good OPA, is having obligations where you can help the developers in going on that journey of capacity building and integrity creation with you over a period of time.
Yeah, absolutely. And I was just going to say that the absence of regulation in the carbon market is a huge challenge, but also an opportunity, because in a private competitive market like the VCM, the voluntary carbon market, what we are seeing happening is that investors are kind of naturally, the demand is kind of naturally going to the more robust, rigorous standards and registries. And the value of credits is quite often determined by where they're registered. And so that actually creates an incentive for that, for the standards to get better. And so in that way, it's slightly self-correcting, but of course, it can be done.
Thanks all, that's brilliant. Okay, well, I think, just conscious of time, I'm sorry to cut off everyone in the room from questions, but I hope that you can kind of hold on to them and ask them afterwards. There'll be a chance to speak to all of our panelists and the session leads. I'd suggest we now move on to creative content, and perhaps we try to keep that to a viewing of the clip and then a 5-minute breakout discussion, just in the interest of time. But thanks, guys.
We take a 1-minute break while we get the video pop up. I'm conscious you've all been sitting quite patiently.
We don't have anything here, right?
I thought it's so, yeah. Information I could see people doing this when I got out of one time. I think we should watch that in front of her and then yeah. I mean,
Are you sure now? Okay.
I feel inspired.
Yeah, that. What's your feedback? Thank you.
And then we have here. I suppose if it's playing through the room speakers, then yes.
I really
Yeah.